Let's talk about interest rates and how they work because they're going to affect pretty much every financial decision that you make in your life. So, back in July of 2026, the Federal Reserve left its benchmark rate exactly where it was. And you probably hear that a lot in the news that the Fed reduced the rate or they increased the rate or they held it where it is. And the Federal Reserve is just this big deal when it comes to interest rates. So, we'll walk through what that actually means. And the reason it matters for you, it's not just some political thing, it's going to decide your day-to-day financial life, how much you're paying for your mortgage, your car loan, your credit card, your student debt, how much you're earning in your savings account. It has effects on the values of stocks and real estate and whatever assets you're hanging on to. It's going to contribute to deciding whether businesses hire or lay off people. So what it actually is basically the cost of borrowing money over time expressed as a percentage. So let's say you borrow $10,000 at a 5% interest rate. And if that's a 5% yearly interest rate, which most interest rates are expressed as yearly terms, that's going to cost you $500 over a year in interest to borrow that initial $10,000. So if you pay it back a year from now, not only do you owe the 10,000 that you borrowed, but you also owe the 500 that it cost to borrow it. Now there's several factors when it comes to deciding the interest rate. So let's say you have $100,000. You can either spend it, you can invest it, lend it, or just leave it in cash. So let's say you decide to give it to somebody else and you let them borrow it. Think about what things you're going to factor in to decide what interest rate you want from that person. Well, one of the things that's going to matter is how long that money is out of your hands or the term. Because while it's out of your hands, obviously you don't get to use it. So somebody that's borrowing from you is going to have to pay for that privilege of using your money. Is that borrower likely to pay you back? Are you even going to get the money back? The higher risk the borrower, the higher the interest rate has to be to justify that risk. How much inflation is expected over that period? Be sure to watch our inflation video if you're not quite sure what inflation is. But basically, the dollars you're going to be getting back are going to be worth less than the dollars you're giving out. So that factors in. Opportunity cost. How much of a return could you get by investing this money or using it in a different way rather than allowing somebody to borrow it? So these are just some of the things that factor in, and this is basically what factors in when people decide to let you borrow money. And that's why even though you might be borrowing money to buy the exact same thing the person next to you did, they might be paying a different rate because of these factors working in the favor of the borrower or the lender, and all these things kind of amalgamate to figure out what rate makes the most sense. Now, central banks have a huge part to play as well. They control one very short-term rate, which is effectively what banks charge each other to borrow money, and that's called the federal funds rate. And right now that's somewhere around 3.63%. And that's basically the foundation for all the other stuff. If that policy rate changes, the bank's funding costs change, then prime rates and short-term market rates change. Then variable mortgages and lines of credit and saving rates, it's all a downstream effect. You might have heard of prime rate, and that's basically a reference rate that banks use to price consumer credit. So every lender is going to set their own, and they move together because they're all based on that central bank rate. So you'll often hear things like prime minus 0.5, plus 0.5. And you'll notice once the Fed or the central bank changes their rate, if you have a personal line of credit or a mortgage, on that next statement, you'll very likely notice that you're either paying more or less depending on what the Fed did or the central bank rate did, whether it went up or down. Your credit card rate is almost instantly going to change because that APR is tied to the prime rate. So then why don't these central banks just put the rate at zero and make it super easy to borrow money? The reason for that is inflation. And if you remember all the wonderful times of 2020, one of the things was that inflation was through the roof. And one of the reasons was because the rate was extremely low and it was very easy to borrow money because so much of it was being printed and brought into existence. So as you can imagine, if there's a limited amount of money in circulation, the value of it is high, the rate to borrow it is going to be high. Whereas if you print a bunch of money, now it's worth a lot less and it's much cheaper to borrow. Again, watch our inflation video on the in-depth details of how that works, but we'll move on for now. A little bit of inflation is normal and expected, and frankly, a good thing. The target is usually around 2% per year, but effectively, too much inflation is the reason why we can't just have extremely low rates at all times. And in keeping with that, why do they cut the rates? Why not just increase them indefinitely and make a bunch of money off the borrowers? The reason is the central bank has to cut the rate when the economy weakens, when there's unemployment, when there's less money moving around in the markets, inflation is below target, or there's a catastrophe like again, 2020. And you'll notice once money's printed and that rate goes down, it's easier to get access to money, it's easier to buy homes, buy cars, make investments, and that's everything that happened during that period. Stocks and real estate go up because the money funding them costs less, but it's not all sunshine and rainbows. Those rates will eventually go up, and this is where people start defaulting on mortgages because they bought a home that they wouldn't otherwise be able to afford. Stocks start crashing because these companies just look good because a bunch of people invested into them when money was cheap, but now their true valuations are much lower than what was expected. So you see stock market crashes. So it's never just free, cheap money. There's always a catch. It usually just comes down the road. Now, there's such a thing as simple interest, which is calculated on the original amount only. So let's say you put $10,000 at 5% simple interest. You will earn $500 a year or $2,500 over 5 years with that investment. And then there's compound interest, and that's calculated on the original amount plus the interest already earned. So that 5% is going to apply annually. So when you start year 2, that 5% is going to apply to $10,500, not just $10,000. Year 3 is going to be $11,025, and then after 5 years, you earn $2,762.82 instead of just $2,500. And as these numbers scale up, compound interest makes a huge difference. And it's amazing for investors, but if you're on the other side of this equation and you're the one borrowing and owing this interest, as you can see, as it compounds, you can end up in a very, very bad spot because of the exact same mechanics. So the bottom line, again, interest rate is the price of money over time, price of borrowing it. The central bank is going to set the base, and then it's going to pass down to you in everything that you borrow or in everything that you invest. It's not about predicting whether the rate is going to go up or down. It's about being on the right side of the equation, taking advantage of borrowed money, whether it's taking advantage of interest rates, whether it's earning them or having your stocks and your assets go up in value when the interest rates are low, and understanding what's happening when interest rates go high and maybe your assets are worth less on paper. It's no reason to panic because now you understand what's going on in the background. And also being mindful of the fact that you're not being taken advantage of and paying other people's interest rate through your mortgages and loans and credit cards, especially that compound interest that we talked about. So hopefully that was helpful for you guys. Be sure to check out the newsletter and the podcast in the description. You can listen to us on any platform. As always, be sure to tell us what you want to hear about next, and we'll see you next time. Cheers.